reaction is that these guys, Achilles and Bruno, you know, really were kind of reporting directly to Jamie. And the kind of risks that they were taking were risks that he sort of encouraged them to take and knew about. I mean, I don't know whether that's true, but if you ask me what I would ask him, I would want to know, you know, didn't you direct this?
Listen, if Bob Dimon gave up some of his bonus, shouldn't Jamie Dimon give up some of his bonus?
Well, Jamie has said, remember, he said to Congress, if the board, that's the board's decision, if they want me to give up and claw back some of my bonus, he'll do it.
And he reiterated that today.
Well, it will be. I met Achilles Macros last summer, and he made it abundantly clear. Maybe it was being boastful, but he said, Jamie Dimon brought me in. I am Jamie's guy. Said it to me. So, Bill, thank you so much for joining us. This has been so exciting having you here. On Market Makers, did J.P. Morgan bankers try to hide billions in losses from those big old London whale trades? A huge red flag, maybe a tip-off to investigators. Plus, behind...
Because there's been so much out there, let's just sort of put and kind of crystallize what we know now. This is what we know de facto after everything that's happened. The Jamie Dimon reputation that was there really since 2008 is done. It's not coming back. Because in financial services, in the banking business, when you lose that reputation as being the greatest risk manager, once it's gone, it does not come back, number one. Number two, since 2008, if you were a hedge fund manager, a mutual fund manager, a trader of stocks, you wanted to get long a financial, what did you do? You bought J.P. Morgan. It was the first name you bought. You put it in the portfolio. Gone. That's not happening anymore. That's done. And the third point here, which takes me back to 2008 as well, actually takes me back to 2007, that UBS Financial Services Conference right before the collapse, when you had Dave Goldfarb at Lehman arguing that investment banks should be trading at market multiples. We know what happened there. We know how that movie ended. Banks are going to trade at lower multiples. It's a result not of just what happened at J.P. Morgan, what's happened really since the last 4 years. So lower multiples for investment banks in the publicly traded markets. J.P. Morgan, not the stock you buy when you want to get long financials anymore. And Jamie Dimon, apologies on a personal level, because I think he is a very good guy, will not have the reputation he ever had again. Leave it at that.
Much, Scott. We continue to watch J.P. Morgan after it revealed the losses stemming from its trading blunder will now exceed $5 billion. Company also announcing on Friday it's restating its first quarter results as federal investigators look into whether traders may have concealed losses. So what's next for J.P. Morgan, and could there be some criminal charges? Harvey Pitt is a former SEC chairman, currently with Colorado Partners, joins us from Washington today. Harvey, good to see you again. Good morning.
Good to be with you. Good morning.
You say your thoughts about J.P. Morgan are not very pleasant in your words. What do you mean by that?
Well, I think they have not handled this with their usual aplomb and dexterity. First, when this problem arose, it was dismissed as a tempest in a teapot, and it seems to be more like ring around the collar, a problem that simply won't go away. And it keeps getting bigger, and the problems keep developing and emerging. So I think this has been not its finest hour in handling this problem.
Does it seem to you like the bank in the early days here shrugged its shoulders at a potential misstep, or is the notion that they were being fed bad information from their desk absolved them of some of that responsibility?
I think the important thing is when you get a problem of this nature and you don't know what its dimensions are, you start out by saying, we take all problems seriously, we're going to look at it very closely, and we're going to fix it, we're going to correct it. I don't think you simply dismiss it and then suddenly find now that you've had to fire people, that you've had to restate earnings, which is an admission of wrong accounting, and face ongoing probes by a number of agencies. So I think this has not been handled the right way.
You say it threatens to become worse. What potentially makes it worse?
Well, I think the thing that makes it worse is we're now up at approximately $5 billion with a potential for another $2 billion in losses. In addition, when this broke, J.P. Morgan lost about $25 billion or $30 billion in market capitalization. That's a loss for shareholders as well. All of that reflects badly on the way the problem was both brought to light and then dealt with initially.
Tail. Trading surges and temporarily boosted the value of credit derivatives held by JP Morgan's CIO London trading unit may now provide new clues about whether traders at the bank hid their trading losses that spiraled into almost $6 billion. These spikes in trading volumes more than doubled just before month end, pushing prices of their largest index positions lower. So what's the takeaway? Well, these trading patterns offer a roadmap for investigators, and if proved to be price manipulation, this could create quite a splash for the London whale himself. And Scar, you know you are queen of the charts here at Bloomberg, so I want to pull up this chart so you can really see how these trading spikes went down. So if you look at this, boom, January 31st, a massive spike in volume. You can see it at the end of February, and then again a month later. So quiet, quiet, quiet throughout the month. And remember, it's at that month end point when these traders mark their books. You know, their books get audited, and that's where they know the value of all their positions. So definitely very suspect to see guys, especially that traded this massive size. You know, the London whale, we call him Bruno Ixel, all month long, completely silent. And then those last 3 days of the month, really driving the market, pushing it, and, you know, pushing it to get at the end of the month the price that he may have wanted for to mark his book.
It seems so obvious in retrospect, right? And it certainly gives the FBI, the Department of Justice, and all those other investigators a roadmap into what to look for and where else to go when they investigate everything.
But obvious, but also people are asking the question, why wasn't this obvious to all of their counterparties? Remember, the rest of the street was trading with Bruno Ixel every month, so they knew that between the 3rd and the 28th, they were completely quiet. But on the 28th, if you were the guy trading against him in an index product, you knew you were going to show up to work that day because Bruno had a lot of business to do. And people are asking the question, really? Well, where are the other banks, those who interfaced with him? Why didn't they raise their hand? I mean, is there not some responsibility to go to management?
They somehow benefited, and so therefore they kept their hands down.
It took journalists.
Of course it does.
Why?
Stephanie Ruhle and Eric Schatzker breaking that story apart.
We did, with a huge team here at Bloomberg. But let's move on to another great part of the day, the options update.
Have been harpooned, so says Jamie Dimon, but he continues to make waves inside JP Morgan. The Wall Street Journal reports that JP Morgan has named board member Lee Raymond to head a committee investigating the bank's multi-billion-dollar trading loss. Raymond and 2 other directors will review findings from JP Morgan's own investigation. They were reported last month. The takeaway, why, you may wonder, does JP Morgan need to conduct another probe into the London whale? We're told it's because the board needs to evaluate Dimon's role in the debacle and maybe decide whether to ding his paycheck. Well, perhaps. But I put this question to FDR Capital Markets analyst Paul Miller this morning, and here's what he said about that first investigation. Quote, I don't think anybody believed it.
He also said that they're trying to put this debacle behind them and trying to put on a display that they're on top of it and that they are being responsible with how the investigation is going.
Let's remember one other thing as well. We're talking about a board investigation as opposed to an executive investigation. The first one was conducted by Mike Kavanaugh, one of JP Morgan's top executives, a key lieutenant to Jamie Dimon. The problem, though, is so long as Dimon is the chairman and the CEO at the same time, it's impossible, right, to separate the board from management. If Dimon did what many people have asked him to do before, which is to relinquish the chairman's role and remain CEO only, and this question came up in the context of the trading loss, maybe the board investigation would have a little more credibility. But so long as, now that's not, you know, to speak poorly of Lee Raymond, whom we are told and understand has been a good foil for Jamie Dimon in the past, but it's just pretty impossible to consider any investigation conducted by the board totally independent when Dimon remains the chairman of the board.
It's a good point. And as Paul Miller also said, it's not going away, no matter how hard they try.
No matter how hard they try.
$5 billion trading loss. All right, in today's options report.
Morgan says employees may have tried to hide losses in those London whale trades. Well, now investors would have to find a way to find out how it was done.
Bloomberg learns Mick Davis would quit to save the deal. And pay cuts considered. Jamie Dimon may lose millions for costing investors billions. What would persuade you to invest in JP Morgan? What if the CEO proved that you and he were in it together? We'll find out why Dimon may forfeit millions for losing billions. Meanwhile, in France, another time. Well, the fallout from one of that series of banking scandals, JP Morgan considering reducing bonuses for its senior executives. Chief Executive Jamie Dimon could be among those taking a pay cut, according to the Wall Street Journal. Dimon was awarded $23 million in salary and bonuses in 2011. This year, JP Morgan's market value has dropped by $20 billion. Some quick math, Dimon was paid more than $1 million for every $1 billion of value lost at the bank. The bank has already lost $5.8 billion on a large position in credit derivatives at its London office. That's a story originally broken by Bloomberg. Now, Dimon may not have left himself with much wriggle room on this one. He's previously said it's up to the bank's board whether his pay should be cut.